Welcome, ladies and gentlemen, to another episode of Mr. Ray's Wealth Academy. Whenever you say Mr. Ray, baby, I need you to be heavy on the Mr. Okay. So in this episode, number 4, we're going to be talking about covered calls. Now, we're talking about selling premium and getting paid on stocks that you already own. Now, if you've been following along, you already know that what options are, and you understand the wheel strategy, and you've learned how to sell cash secured puts. Now we're going to be completing the second half of the wheel. Let's get into it. All right, before we dive in, let's make sure that we're grounded. Now, everything that we do in Mr. Ray's Wealth Academy is built upon kingdom finances. And those finances are built upon 4 pillars. The first thing is ownership. God owns everything. We own nothing, baby. He's just given us the opportunity, that is the stewardship and the responsibility to manage his goods. Not only are we managing his goods, we're also going to be held accountable one day, right? And that accountability brings with it rewards. And so the whole thing is ownership, responsibility, accountability, and then a reward. God owns it all, baby. We're just here to use what he has given us for his glory. All right, so a quick recap, what we've learned so far. In episode 1, I actually taught you about what are stock options. In episode 2, I introduced you to the wheel strategy. And episode 3, we talked about cash secured puts. And now we're here today at episode 4, and we're going to be talking about covered calls. That is, this is where you get paid even if you already own the stocks. Okay, so what is a covered call, Mr. Ray? Well, you can only sell a covered call on stock that you own. You got to at least own at least 100 shares of that stock, right? So you either signed it or you had bought it in the open market. Number 2 is you sell a covered call. That is, you're setting a strike price that is above your cost basis, and you're going to collect premium immediately for making that sale. That's income that's going to go directly in your pocket. And then there can be 2 outcomes. The stock stays uh, below your strike price, you get to keep the premium, it expires worthless, and you move on. If the stock goes above your strike price, then it's going to get called away, but you're still going to make a profit on that. So let's go ahead and talk about that. All right, so here how it works step by step. Step 1, you are going to own 100 shares of the stock. It was either assigned to you or you already own it. You're going to pick a strike price that's above your cost basis. That is, whatever price that you bought the stock at, or if you were assigned the whatever price you were assigned the stock, less whatever premiums that you receive. And then you basically are going to sell a call option and collect an additional premium on those same stocks. And at that point, you're going to be waiting the 30 to 45 days, whatever your expiration date was, and see what happens. Now, there's only 2 things that can happen after you get to the expiration date. One is the stock has risen above your strike price and it gets called away. But you get to keep the profit, the difference between the strike price and the stock price, and you get to keep the premium, and that reduces your cost basis. Now, the other thing that could happen is that the stock stays below your strike price. In that case, you keep your stocks and you also get to keep the premium. So let's look at an example. Let's say you have XYZ company and you have 100 shares of that stock. And the cost basis is $48 a share. That's either what you were assigned it or that's how much you purchased it for. Let's say the stock is trading at $50, okay? And so you turn around and you sell a call above the $50 at the $52 price. And in turn for that, you receive $1.20 a share, which means that you have 100 shares, so now you get $120 that's put in your pocket right now. Now, if the stock goes above the 52, right, and the shares get called away, you profit. Okay? You have a $400 gain from the stock gain, plus you get $120 in premium. That's a total of $520, which is a 10% return on that transactions. Now, if the stock stays at 52 and it doesn't get called away, you simply get to keep the $120. And now your new effective cost is 46.80, right? Because you had the stock basis was $48, but now you got $120, so that reduces your stock basis, your cost basis down to 46.80. Either way, you're a winner here, baby. Okay, Mr. Ray, how do we pick the right strike price? Okay, here's a golden rule for you. Golden rule number one, always pick a price that is higher than your cost basis, okay? You want to be close to the current price, which means you're going to get a higher premium, but not so close that it's going to get called away, okay? Far above the actual strike price means that you're going to get a lower premium, but you get to keep your shares more often. The sweet spot is a spot that's like 5 or 10% out of the money. Okay. So you're going to get good income, but you're also going to get a good opportunity for the stock to grow without it being called away. Now, what I need you to understand is not, don't be afraid of getting your shares called away. When your shares get called away, you're selling them at a profit, right? You bought them at your cost basis, right? And you sold it at the strike price that was above your cost basis. And you collected a premium on top of that. Now, your total return is your strike price less your cost basis and all the premiums that you collected all that time. Now, what happens if it gets called away? You just simply start the wheel all over again, baby. Sell more cash secured puts. All right, let's put it all together. Here we go. Step one, we're going to sell cash secured put and we're going to collect the premium immediately. But we're also going to have enough cash available to buy 100 shares of that stock should it breach our strike price. Step two, let's say it breaches our strike price and we get assigned those shares. We're going to take those shares now that we own at a discount because we received a premium, and we're going to turn around and we're going to sell covered calls and collect more premium. That's what I just taught you today. And then step four, if it gets called away, we just turn around, rinse and repeat, baby. Just do the same thing. We turn around and we sell more cash secured puts. Now, here's the beauty of this whole strategy. Now, you've been selling covered calls on this stock ever since you were assigned it at 50. So every time that you collected a premium, it reduces your cost basis. So you sold a covered call at 120, now your cost basis is 47.30. It expired worthless, you sold another covered call at $1, now your cost basis is going down. So every premium that you collect, that's lowering your risk, baby. That's the power of the wheel, baby. Let's go. All right, now it's time. Keep it real, baby. There are risks. Now, with every, I always tell people there's no reward without a risk. And so let's talk about what the risks are on this particular strategy. Number one is that you are capped on the upside of the stock. Let's say the stock just blows past your strike price and it goes up 100 points. Well, you're not going to get the benefit of all that appreciation. You're only going to get up to the strike price. So you are limited to the gains on what you have on your strike price. Okay. Now, the stock can still drop, right? Your shares, you own these shares, the stock can drop significantly. Now, the premium you collected helps offset some of that loss, but if that stock drops all the way down, you're going to assume that loss. That's what anybody would have if they bought any stock in the stock market. You are at risk at any time for that stock to go to zero. How often or how likely is it to go to zero? Depends on the stock, baby. If you have like Amazon or Microsoft or any of those stocks and they go to zero, then the whole stock market is probably going down. Okay. So there's also what we call the opportunity cost. As long as you own that 100 shares of stock and you have sold a call against it, you can't sell those shares. Okay. During that period, that is the opportunity loss. You can't sell it without closing that option first. All right, let's do a quick recap of what we learned today. A covered call lets you earn income on the stocks that you already own. Okay. Always sell above your cost basis. Never sell below your cost basis because if you do, you're locking in losses, baby, and those are realized losses. And thirdly, covered calls are the second half of the wheel strategy. Buying, selling cash secured puts is the first option. Also, between the call and the put premium, your cost basis continues to go down. And that's what you want to do, continue to drive down that cost basis. Now, this is a methodical system, baby, where you can get income when you sell cash secured puts and you get income when you sell covered call. That's not gambling. All right, baby. Now we got this thing figured out because we now understand both halves of the wheel strategy. But in episode 5, we're going to get real practical. Now we're going to get into some real life stuff, and I'm going to show you exactly how to pick the right stock for this strategy. Every stock does not work in the wheel, and I'm going to show you what to look for. So simply hit that subscribe button and the notification bell so you don't miss when I'm going to give you the next opportunity for you to grow in this strategy, babe. Come on, let's build, let's grow, and let's prosper. All right, now I got to give you my disclaimer here. This is only for educational purposes and does not constitute financial advice. Option trading involves significant risk and it's not suitable for everybody. Always do your research, consult a licensed financial advisor before you make an investment decision. And also, past performance does not guarantee future results. Mr. Ray does not provide personalized investment recommendations. Have a good day.